Good afternoon. Asian markets fell across the board following an overnight sell-off on Wall Street. The Nikkei in Japan dropped 2.8% and Hong Kong's Hang Seng Index bucked the generally downward trend and rose fractionally higher. Chinese mainland shares struggled for gains and ended the day lower. Over in Europe, European stocks nudged higher, seemingly shrugging off concerns about rising bond yields while digesting a slew of corporate earnings. Investors remain jittery over the U.S. Federal Reserve's schedule for hiking interest rates and tightening its ultra-loose pandemic-era monetary policy. Bank earnings continue with reports from Bank of America and Morgan Stanley slated before the markets open in the U.S. To talk to us about how all of that is playing out with our local markets, we are joined by Michael Traherne from Vestec Asset Management. Michael, thank you so much for your time. I mean, what do you make of the JSE's performance? And I suppose an added question, any local company news that caught your attention?
Yeah, afternoon, Nastasia. I'm pleased to see we are in the green today after a horrible trading day globally yesterday. Stocks seem to be making a rebound, leading the charge this morning. Richemont up over 8% on their latest numbers. That's because they say that compared to 2019, 2020 doesn't exist, so we don't look at those numbers, but compared to 2019, their jewelry sales are up 38%. It shows how much money people are sitting on, how much money people have made globally since the pandemic started. And there's a massive demand for jewelry and luxury goods. This would go in step with what Anglo-American said yesterday regarding their De Beers group, where De Beers has increased the sales price of some of their diamonds by up to 20% due to higher demand. So that's been good news. Unfortunately, on the downside today, we see Aspen. They're down 6% this morning, and that's on news that they won't be selling one of their divisions. It's their API division, and that means it's the division that creates the building blocks for medication. Aspen said that division's been hit by COVID, and they won't realize full value for it until COVID is behind us.
All right, so we had results out of Goldman Sachs yesterday, and as a result, that share price falling nearly 7%. They saw a drop in trading revenue, but compensation costs also happened to soar. And again, this is the battle of trying to retain staff. When you look at the story of rising compensation costs, I mean, is this a theme that we will be seeing across Wall Street, especially when you take into consideration what JP Morgan and Citigroup also went through on a cost basis?
Yeah, I think as we stand now, there's no doubt that salaries, particularly in the professional realm in the US and the developed world, are going to see sharp increases. Globally, in the developed world, there's a shortage of workers, particularly in the professional side of things. And when there's a shortage, it means prices have to go up. And on Goldman Sachs' side, it meant that their operating costs were a lot higher than the market was expecting, meaning lower profits, and that's why the share price is down 7%. This isn't always a bad thing, though. Higher salaries mean higher spending, and it means higher profits in other areas of the economy. So we just need a cycle to work it out, and we'll see the profits in other companies coming through because of these higher salaries.
We also had news that Microsoft is buying Activision in a $69 billion deal. It's a very interesting company. It had some high-profile issues. What do you make of the acquisition for Microsoft?
It looks very opportunistic. I think it looks good for them. Microsoft has said for a while that they want to be a dominant player in the gaming space. Obviously, they've got Xbox and they've got games that they publish through their Microsoft platform. But having a big player like Activision with big brands like Call of Duty or World of Warcraft, that's taking them to the next level. Activision share price is down 30-40% over the last 12 months due to internal issues. Their CEO has been accused of misconduct. There's been restructuring and firings. And because of that, the share price is down. We'll offer you share price plus, and that's the price that they're now buying it at. So Microsoft taking advantage of these issues to bolster their gaming division for the long run.
Right. Speaking of gaming stocks, I mean, when that news announcement came out, we saw a global gaming stocks rally. Do you as Vestec like gaming stocks at all?
It's a bit of a side bet. We own it for a few clients. It's a very interesting sector because millennials who are now in their peak working careers seem to still be gaming. And now that they have a lot of money to spend, they can spend the money on gaming. So we think that it's a sector that's still underrepresented. But it can be tough to find the right studios because it can be hit or miss. You can make one amazing title and then you have a few duds afterwards and then your company struggles. So high risk sector. I think for us, we would like to stick with the likes of Microsoft who are building their gaming division amongst others and have it as a periphery.
On that note, on sectors, are there any sectors that you're liking right now, given the current environment that we find ourselves in?
Yeah, we sort of agnostic to where we are in the cycle. Vestec will buy for the long term, regardless of what the cycle's doing. It's easier to predict long-term trends. It's a lot harder to predict these shorter-term cycles. When do they start? When do they end? Do you get in now? Do you get out later? So for us, technology is one of our biggest investments where we've been focusing clients' money for the last decade, and I think that's where we're going to be for the next decade. So the current 10% pullback in the Nasdaq looks like an amazing buying opportunity to us.
All right, Michael, thank you so much for your time. That is Michael Traherne from Vestec.